Good afternoon and welcome to this webinar, which is my Q4 presentation on eToro. And my name is Christian Jane Kongstedt. My nickname on eToro is TPH Equities, as most of you may know. And today we're going to speak about what has been happening the last quarter and the last year, and also what's going to happen going forward, what my strategy is and what I think about the results. So I'm going to start out by saying a little bit about myself, just a few minutes, and then I'm going to say something about the strategies that I'm employing. I'm going to say something about the current markets, and we're going to take a view of the portfolio to see how things have changed since the last over the last 3 months. So first of all, a little bit about myself. As you know, my name is Christian Jane Kongstedt. I studied originally as a journalist in the city of Aarhus, which is the second largest city in Denmark, which is where I live. I have been having a career in online marketing for quite a few years, working with Google marketing, Facebook marketing, Amazon, and some of the big tech companies that I'm investing in today. Since 2012, I've been using more and more time on investing and trading. So I started out doing it seriously 10 years ago. I was investing 15 years ago, but then 10 years ago, I really started to taking it serious and started to using much more time on it. And since 2015, I've been using 50% of my time on trading and investing. And these days I am full-time on investing and trading, and I'm working with this all of the time. Personally, I am very much into games. I like to play Scrabble. I like to play chess. I was an elite chess player until I stopped playing 15 years ago. And I'm also a 4 times Scrabble champion in Denmark, which is my country. And one thing that I can tell you is that I love games, I love numbers, and this is something that I use as well when I analyze the stock markets. So these are some of the things that I like about trading and investing as well. I think playing games at a high level has taught me some things. First of all, I have a highly analytical approach when I tackle problems. I have strong pattern recognition skills, which is something I've been using in chess, but also can use in the financial markets. I've been studying and have become an expert at several different topics, and lately I'm working with the stock market. But I've been working with obviously becoming an expert in chess and Scrabble before that, and I can use some of the same tools and the same approach that I've been using when studying games. And one thing that's very important, I think, is that I keep my head cool when under pressure, and that's something that has been quite important this year, because this year we've had a lot of pressure in the financial markets, and I think it's important to stick to your strategy even when things get a little bit tougher than they are usually, and this is what it has been this year. I love a good challenge in any way, whether it's climbing a mountain, running a marathon, or something else. But these days, my main challenge is to perform well on eToro, and this is what I focus 100% on. I have written several books, mainly about different games. Games like chess, poker, games that I've been playing. And the latest book I wrote was about day trading with my good friend Eric. And we interviewed some of the best day traders in Denmark and wrote a book about it. And this got me very inspired to start trading myself. That was 7 years ago, on top on doing the work I've been doing with investing. And these days I see myself both as a trader and an investor. I got a lot of inspiration by meeting some of the best traders in Denmark, and this is some of the things that I use today when I trade and invest. I'm quite often appearing in financial media, especially in Denmark, of course, but also in international financial media. And my expertise is to speak about tech stocks and the tech market in general. I also speak about crypto and but especially big tech has been my specialty, and I've often been interviewed about that. Lately, I think I've been appearing in a few podcasts in Denmark. Yeah, which is something you would see a picture from here. And about the performance this year, obviously this has been a tough year, as all of you know. So far, until this year, I have been having 2-digit positive returns all full years, but that's going to be difficult this year, of course, to achieve this again, because we don't have much time left of this year. In any case, my annualized return is around 19%, whereas the normal stock market is about 8 to 10% in the same period. So I've almost been having twice as high returns as the general stock market. So this is mainly due to me performing twice as good as the stock market for the last 5 years. And this year I'm performing more or less like the general stock market. So if you look at the Nasdaq, it's down around 27%. I'm down 23%, and the S&P is down 15%. So I'm kind of in the middle of those two main indices in the US, and obviously I would have liked this year to have gone better than this. But on the other hand, if you look at my clear overperformance for many years, and then this year I'm performing more or less like the market, I think it's generally acceptable. But of course, I hope to return to the overperformance of the last 5 years once again. But it seems like I performed much better in a bull market and a strong market. And this year, when I have a bear market, I'm performing more or less like the market. And that's okay if you compare to most other tech investors, which would be down like anywhere from like 40% to 80% this year. I managed to get out of the most risky and non-profitable tech stocks in time. And because I did this, my performance is actually more or less like the general market this year, which I think is okay. One thing that I want to point to your attention, and which I wrote a post about recently, is that you have to take into consideration that also you have some currency headwinds or tailwinds, depending on how you see it. The dollar, US dollar, has been very strong during this period over the last year. And in fact, when I had to provide my earnings report for my company, in which I trade with the eToro account, it actually turned out that for the last period of October 2021 to October this year, even though you see the numbers have been not very good if you look at the nominal numbers, like I've had a very bad month in April with a double-digit return, negative return. But even if I had this, my losses on the investments in itself were a little bit above $10,000, but the headwinds, no, the bonus or the gains I had on the currency was actually more than I lost on the investments, because my currency is pegged to the euro. So this means that actually, even though this was my worst year so far on eToro, I managed to have gains on my overall investment due to the dollar being very strong. And then what I've been writing in this post is that the US stocks are inversely correlated with the US dollar, meaning that when the dollar is very strong, you will see some of those main strong international companies, like the big tech companies, going down in value because they are inversely correlated to the dollar. But this means that actually, if you measure your investments in euro or British pounds or yen or some of the other currencies that has been much weaker than the dollar, you may actually not have had so big losses. And in my case, it was actually a profitable period, even though the numbers, when you were just looking at eToro and just looking at it in US dollars, looked very negative. So those were the nominal numbers, but the real returns were actually positive during the period, which may be a little bit surprising to some. So so the overall, I'm not too unsatisfied about the last 12 months, because even in my worst period, I was actually slightly profitable. So my overall goal on being on eToro is to take this account to $1 million, and I'm going to, of course, measure this in dollars. And the way I'm going to do this is to use 16 years. I've calculated around 16 years to take the account to this amount. And I think that if I have a return of around 17% on average every year, I will manage to get to $1 million. And the question is then, how am I going to do it? And the main strategy at this point is to be mainly long stocks and try to overperform the stock market, but also to supplement my account by doing some algorithmic trading strategies that are a bit more short term and that can diversify the portfolio. And that's something that I'm going to speak about on the next slides. So what you see here on this table is the path to $1 million. And obviously this is going to be average returns. So this means that in some years, actually the stock market can go down and you will lose value, but other years you will see double-digit returns. And so this is the average figure, but it may vary a lot, of course. So if you look at stocks historically, it's quite seldom that it's actually like 8 or 10% a year. It has a very big variance. So it's like you may have very negative years and very positive years. But overall, if you have on average 8 to 10%, then that's what you should expect of the general stock market. And then on top of this, I expect to overperform slightly on choosing better stocks than the market, but also overperforming on algorithmic strategies. So just to give you an update on the way I see the portfolio today, I will keep 70 to 95% of my funds invested in being long the stock market. And the target is to deliver between 6 and 10% per year on average in returns from these stocks. It may be much more some years, as it has been so far. I had some years with over 40% of gains or returns in 1 year, but also you can risk, as this year, to have negative returns in some years. And then 5 to 30% of the funds I want to invest via algorithms that I'm trading. I'm trading this with a very low risk, very small positions, but I expect this part of the portfolio to deliver an almost similar return. So my target would be to, via the algorithm, to have a 0.5 to 1% a month of return, which means 6 to 12% of returns via the algorithms a year. And at this point, I'm not at this level. I think the algorithm so far has contributed with around 3% in around 6 months. And that's okay, but I expect them to perform better over time as I'm adding more algorithms and adding more strategies up on top of the long-only stock portfolio. And I'm going to give you an update on those strategies on the next slides. So overall, my target would be to have a yearly return of between 12 and 22%, which is 17% on average. And in this case, if I manage to do that, I will reach my goal of $1 million in 16 years from now. So that's my plan. So the advantages of having 2 different components in the portfolio, like the long-only stocks and also the algorithmic strategies, is to have a possibility of having higher returns than just investing in stocks, and also more diversification because I'm less dependent on the stock market's performance. Like this year, the portfolio has been hit quite hard by the stocks performing worse than expected, and hopefully in the coming years I can change that a little bit so I'm not as exposed to the big swings in the stock market, but also a little bit more to the stability of some of those algorithms that I'm going to be trading. So what I'm trying to achieve here is to have a low risk approach to achieving high returns, because I'm only going to be risking maybe 0.2% a trade. So I'm going to keep it very safe when I trade those algorithms, and that's my plan. And to give an update on the strategies I'm trading right now, I'm trading a Forex strategy, which is being traded quite lightly. It's a profitable strategy. It has been going well, but the problem or the challenge is that there are only quite few trades. I'm usually in just one trade a day. I think at this point we're live in one Forex trade, and that's the average that you would have during this, where the strategy I used to trade, I would be in 10 Forex trades at one time. But the problem is that the market changed, so this Forex strategy was not profitable anymore, so I had to change it. And I managed to do it before it actually turned unprofitable in my account. But the new strategy works very well, I think. But I'm trying to find out how to trade it in a better way than I'm doing now, because the challenge is that this strategy and also the SP500 strategy that I'm trading, those strategies are being traded 24 hours a day. And obviously I'm only awake like 12 to 14, maybe 14 hours a day. And I can only trade during this time, so I cannot take all the trades, and that's the challenge right now. So I'm trying to find a way to actually trade it more of the time, and that's what I'm investigating right now. I'm also I've started trading a stock picking algo strategy, and I started in November trading that strategy, and the test looks very good. I think it's especially something that can be very profitable and have a very strong be a very strong component in my portfolio during a more bullish market. And right now the market has actually been quite bullish over the last weeks and months. Right now it's too early to say how it's going to perform in the portfolio, but I'm quite enthusiastic about it because I see some really promising results in the testing. And so I'm going to tell a little bit more about the strategy in a moment. I'm also testing a manual trading system that trades indices and Forex, which is based on supply and demand zones. And that's not something I'm ready to take live into the eToro account right now. Maybe I can tell more about it in 3 months if it's profitable what I'm trading on another account. So that's what I'm going to be doing. So so the challenge for the strategy I'm trading, or what I've been doing with this algorithmic strategy, is to try to find stocks that explode in price like stock rockets, and that's what the strategy is set to be doing. And I already spoke a bit about this strategy in my last webinar, so I'm not going to say so much about it, except from what you're trying to do is that you're trying to take a part of this move that you see in stocks that are really performing very, very well, and you want to be a part of this very profitable move. And I've analyzed with my partner Jakob Hausmann, who is actually programming this. He has been investigating this strategy for 1 year now, and it's really promising, the results we've been seeing trading those potential stock rockets. So that's what I'm going to be doing during the next period of time. And if you trade the system with a quite low risk, which is only using 20 to 20% of your portfolio, you could actually have a compound annual growth rate of around 17%. I'm probably going to be trading it with less risk on the account because I want to keep it safe. But overall, it looks like a strategy which is not very risky, in the sense that it has very tight stop losses. So this means that as soon as the market goes against you, you will be out of the trade. And this means that you can trade it in a very safe way. And it looks good in the test. And now I'm going to be trading it live on eToro. So that's really interesting to see how it's going to be. Right now we're inside a trade which is Algorithmic, which is KE Holdings, and I think it's actually going down a little bit today. So we'll see how this trade develops. When I made this screen dump in the weekend, it was actually had gone up 10% in 3 days, but today I see it's going down somewhat. So we'll see where this trade ends. But it's actually quite interesting how well this strategy has been finding stock rockets over time. But a lot of the trades are not actual like stock rockets. So, and those that aren't, you just have to get out of the trade as soon as you can, because then if you have a very tight stop loss, you don't lose much, but you may get into some of the really well-performing stocks over time. And yeah, I said some more about this strategy in the last webinar. So if you want to know a little bit more about it, you could go back and take a look at that. Then I want to say a little bit about the current markets. Obviously, the sentiment now is a little bit more bullish than it used to be, just like 3 or 4 months ago. And the reason for this is that the Fed has sent the signal that they are going to be probably starting to have smaller interest rates hikes coming already in December. And this means that they are going to slow down the pace of the interest rates that they have been having, the hikes they have been having most of this year. And that's a positive sign for the markets. Also, we're seeing inflation numbers, the rate of change going down, and this means that the markets are slightly more positive than they were just like 3 or 4 months ago, because when inflation sets a top, you usually see interest rates having the top as well, and the stock market bottom out. And if this is what we saw just a few months ago, then there's good reason to be bullish at this point. But also you have to consider that the effect of the rate hikes has not been seen yet. So those are the bearish arguments that what we're seeing is that interest rates are high, and they're probably going to stay high for a long while. And the thing is that this is going to affect the economy in ways that it's not really possible to predict at this point. But one thing is for sure, we will see more layoffs, and not only in the tech companies, but also in other sectors. And that may affect the whole economy as such. So some of these effects are going to be more clear to us in 3 months from now. And some effects of this are going to be delayed. So that's, of course, something that I'm going to be following very clear. So according to Goldman Sachs, there's a 39% chance of a growth slowdown, which is like a recession. But this also means that there is a probability of avoiding an actual recession, and that's something that we should take into account. And overall, I'm slightly optimistic at this point, because I think that the US economy is still very strong. We still have a very strong labor market in the US, and at this point we don't see the strong signs of a recession coming. So I'm quite optimistic at this point, but obviously this is based on the information we have right now, and in 3 months time things could look different, and this is also depending on the information that comes out all of the time. So it can change over time, but at this point I'm slightly optimistic, I would say. So overall, I would say that the market has changed its sentiment to a risk-on sentiment, which means that some of the slightly more risky stocks, even some of the unprofitable tech companies has been starting to perform very well again. But I think this can soon change again. So I think we should still be careful coming out of this, all of these challenges with higher inflation numbers, high interest rates, and a possible recession coming. So I think it's too early to go into the risky high growth stocks at this point. So I think the challenge of next year, and especially for the first part of the year, is to try to navigate between inflation and recession. You have inflation on one side, and the Fed is trying to make those interest hikes to try to avoid or to try to get inflation down. But in this process, they may actually end up forcing a recession, and that's the challenge. So you have the two sea monsters on both sides, like in the Odyssey, and trying to navigate through this small path there is the challenge, and it's not going to be easy. But I think that at this point there's a possibility that it will happen, and for this reason I stay slightly optimistic about where we're going from now. And I think at this point, based on this information, the situation is actually not too bad. So the portfolio, just an overview. My portfolio is based on a core which is staying mostly the same. Sometimes I change the weights a little bit depending on which companies I see are the most promising at the time. But those are some of the companies that has been defining the last decade that we went through. And I think also, even though they haven't been performing well, all of them this year, they will also be defining this decade because they have the infrastructure, the IT infrastructure that is the basis of most of the important things in our society, and it's going to continue like that. And it's very difficult to see that they can be challenged at this point. They are internally competing, for instance, on cloud computing. They're competing on AI, they're competing on the metaverse, but they are each other's main competitors. And I don't see many other companies out of this group having a strong chance of competing with these companies. I think they will overperform the stock market at least over the next 3 to 5 years. And for this reason, I keep them as part of the portfolio. I think it's, even though they have had, in some cases, a performance that's just below the market this year, it may set them up for overperformance over a following period, because they are companies that will strike back strongly as soon as the smoke has, as soon as we have a clearer situation. And for this reason, I think those are the stocks to be in and stick to for a longer period. And I have been invested in those stocks for 10 years, and some of them I changed the allocation. I used to have a higher allocation for Meta, for instance, but at this point I find it slightly more risky, but also with a higher potential upside than some of the other companies, because it has a very low valuation at this point, and for this reason I think that it has potential to perform very well over a 5-year period. So for this reason I keep it in the portfolio and as a part of the portfolio. So my portfolio is basically still at its core a tech portfolio, and also you will see here in the top here, I have some exposure to cybersecurity. I have some exposure to cloud computing, which I think is a really important development during this decade, and an industry which is forecasted to be growing very fast. And the companies that are the green companies, and also some of the light green companies, are some of the companies that are going to benefit from this development, even though they currently have a few headwinds from the general market. Then I have some exposure for more traditional, the more traditional US companies through Berkshire. I have some exposure to India, and I also have some exposure to payments companies like MasterCard and Visa. And actually those two companies are also kind of part of an inflation hedge, because this year, as you know, the inflation has been like 7, 8, 10%, depending on which country or continent you're on. But the thing is that MasterCard and Visa, they are still getting their fees based on the higher prices of different products. And this means that their fees are also going to be 7, 8 to 10% higher. And for this reason, I find them a good hedge against inflation, like some of the other positions I have in my portfolio. So basically, some of the banks here, some of the companies that should profit from higher interest rates, and for this reason I like to keep them in the portfolio, and also have quite a lot of exposure for commodities and energy, which is also an exposure or a hedge against a more inflationary scenario, and also a hedge against an energy crisis, which we have been facing, at least in Europe, and maybe facing also next winter again. So I think that's quite important to have this in the portfolio as well. So the portfolio is hedged against inflationary scenarios, and also a scenario where we are in an energy crisis. And then the last thing that I find it important to hedge against is a recession scenario. So the position I have up here, the positions I have here, is a cash position, and that's a bit variable. At this point it's 3%, but it may actually be slightly more over the next month, because I'm going to free some cash to trade more of the algorithms. And then I have some more defensive positions here. I have a small US dollar position, and I have positions in the health sector, which is an ETF, and also utilities, which is some of the utilities companies, which I find is a good hedge against a recessionary scenario, in the sense that I think that even if you have a scenario with a recession, you still have to pay your energy bills, you still have to pay your heating bills, and inside this ETF you would have some of those companies that are the benefactors of this potential development. So, and this recession hedge may be growing over the next period if I see if there's a risk of recession that's getting higher, or it may be much smaller if I see that we have a scenario that's more risk on, and if it seems like next year is going to be better the year than is expected currently. So I'm going to turn up and down the volume of this section over here, depending on how things develop regarding a recession. So that concludes the first part of the presentation so far. I want to say to you that even though it has been a tough year, I think it's important, and probably even more important, to remember in a negative year that you should still keep investing as a habit, to take a little bit out of your paycheck every month or maybe every quarter and invest it. You can invest it in basically anything, but I think investing in the stock market is something that has shown to be very promising over time. If the market goes up, you will profit from this, and if the market goes down, you may be able to buy more at a lower level. So it's basically a win-win situation if you do it over a long period. So if you have a long time horizon and if you have patience, then you should be able to achieve good returns with trading and investing, like I have done, and you can see my results for the last 5 to 6 years. So even when you have bad periods, then try to think about to keep your long-term strategy, which is to keep staying invested in the market, because during those negative periods and this negative year, you may actually be able to buy stocks at a lower price, and that's going to be beneficial to you in the long term, even if it's not going up tomorrow or next week or next month. Then over time you're going to profit for this. So this will conclude the first part of the presentation. And then I want to say that you can actually ask questions by going to the Q&A, and I want to take a few questions, and you may write your questions in the questions box, but I'm going to take a few of the questions that I got on my wall, my eToro wall, and answer those first, and then you can write more questions if you have them in the chat box or in the Q&A box you see. So I had a question on eToro saying, algorithms buying and selling, it's set to worsen sell-offs in the market, but is it the way forward? And my answer to this is obviously that I find that algorithms, for me, is a good way to diversify my investments, so I'm not depending so much on the stock market in general. I believe that going forward, the stock market is, if you look at a 3 to 5 year horizon, my opinion is, and that's obviously not investment advice, but my opinion would be that that it is likely to be profitable good years in the stock market, and I like to keep most of my funds invested in the stock market, and especially the US stock market. But I think that algorithms for me is a very good way to diversify and make sure that I have something that can rise in value when the stock market falls. And if you think about that, algorithms, some algorithms could have a negative effect. I think that you have to take into consideration that algorithms are always programmed by humans, and basically they're just doing what humans told them to do. So the algorithms doesn't have any blame themselves. It's humans trading the market, but some people are just using algorithms, and they're doing it, using them for lots of different things. So I don't think that algorithms are to blame for sell-offs as such. If they oversell the market, then you will quickly see experts coming back into buying stocks again. And for this reason, if you have inefficiencies in the market caused by algorithms, it's quickly going to change again. So I don't see this as a risk in the market at all. And then I had another question, which is that it seems that the Feds are loosening rate hikes, which could indicate a rebound in stocks and equity markets. Do you plan on going a bit more aggressive with your investments to use this opportunity? I mean, going back to some of the cheap high growth stocks. And yes, this is something that I've been considering, but I don't find the moment right for this yet. So if you had been investing in the high growth and maybe some of the unprofitable tech companies in the last month, it's true that you would have been profitable for this month, the last month. But the problem is that going forward, there's still a quite high risk for those companies because interest rates are pretty high, and I think they're going to stay high for maybe a few years, and those companies are to some extent going to suffer from this fact. And for this reason, I think it's too early to jump back into the high risk and unprofitable growth stocks. But I can tell you that I'm keeping my eye on this, and if it changes, I'm going to jump back quickly into the market jump back into those stocks again. But I really don't think it's the moment right now. I think we have to stay more careful at this point. And then one question was directed against what my take is on the upcoming recession. Will it be as severe as forecasted by Elon Musk, Mark Zuckerberg, and others? And then I just want to say that it's referring to this specific article in Business Insider. And one thing to note is that Elon Musk and Mark Zuckerberg didn't actually predict a recession. Elon Musk was just saying that he wanted the Fed to cut the interest rates because otherwise they would be amplifying the probability of a recession. And that's a reasonable opinion to have, but it doesn't mean that he predicts that a recession is coming for sure. And in any case, I would rather listen to expert analysts in this exact topic than what he has to say about if a recession is coming or not. It doesn't mean that of course, in my portfolio, I want to keep the recession hedge, and I may also have a larger recession hedge going forward. I may even short the market at some point if it's necessary. but at this point, I think that we have to watch how the data, what the data tells us in the US, and at this point, we still have to see this turn in the markets, and also Mark Zuckerberg didn't really predict a recession as such. He just said that they had to pull back, and that's obviously because the advertising industry is somewhat affected by the nervousness in the market, and also the recession risk. And of course, it can happen. And in this case, I'm just following the numbers very closely to see if it's going to happen. At this point, I don't see a clear sign that we're going into recession. So we'll have to wait to see how this develops. And then I got a few questions in the Q&A box. And first question is, in your opinion, what would be the key catalyst for the market to turn bullish in 2023? And that's a quite good question, I think. I think there could be several catalysts. So the first thing is that the Fed is going to set down the pace of the rate hikes, which means that they're going to probably stop raising rates with 75 basis points, going down to 50 basis points, which is a positive sign for the markets. And then at some point, they're going to stop making more interest rate hikes. And at this point, that is most likely going to be a positive catalyst for the market, because when it happens, it means that the interest rates are probably not going higher, but they may be going down at some point. And actually, the market expects that we will see rate cuts later in 2023, which is another potential catalyst for the market to turn bullish in 2023. So I think there could be several catalysts that are related to what the Fed is doing, and which makes it likely that we could see positive and good returns in 2023. This is by no means sure. We have to think about how unpredictable the world can be, in the sense that when we went into this year, almost no one would have predicted that we would have a war in Europe. And when we went into 2020, almost no one would have predicted that we would have a global pandemic. So obviously, things can change over time. But the way it looks now is that the Fed is going to slow the pace of the interest rate hikes and actually stop at some point, which is going to be bullish for the markets, most likely. And then if they actually make rate cuts later next year, that's going to be very bullish for the markets. It still remains to be seen if this is going to happen. Another positive catalyst is obviously if the war in Ukraine at some point, if you start seeing peace negotiations sometime during next year, and again, it can happen, it may happen, but we cannot be sure, that would be a positive catalyst for the market. And another potential positive catalyst is that we could see inflation numbers come down a lot, and that may be a positive catalyst for the market as well. On the other hand, if we don't see this, if inflation stays pretty high, then we are not going to see as bullish a development as we could hope for. But there are many potential catalysts, which is basically, most of them, the most important ones, are around the rate hikes and about the inflation numbers, and also avoiding a recession, because to get a bullish scenario in 2023, we need to at least, of course, if we avoid a recession, it is going to be bullish. But if we have a mild recession, it may be okay too. If it's short and if it's mild, then it's probably not going to affect the markets too much. Then I have another question. In short term, do you think we'll have a reverse of the Santa rally we see currently, maybe in January, February next year? Usually I don't give short-term predictions, so I should probably just say that at this point I'm I'm slightly optimistic about the development, like short term. But obviously, as we've been having a quite bullish run, I think the market has risen like 14% over the last 1 month and a half. It's likely that we could see a short pullback, but the undercurrent in the market right now is positive, because we are seeing inflation numbers come down. And until this changes, if we see this trend continuing, that the inflation numbers are coming down, and we see the Fed are making smaller rate hikes and stopping rate hikes at one point, then the undercurrent of the market is going to be positive. So obviously we can have pullbacks in the markets, and that may be coming in January, February, but those could be short-term pullbacks. Overall, I'm slightly optimistic at this point based on the information that we have right now. Then I'm being asked if algorithmic trading, if I involve artificial intelligence techniques. And yes, I do in some cases use machine learning, or the teams that I'm working with are using machine learning. So that is being used to some extent.